Welcome to the MUFG Global Markets Podcast. I'm John Cook, and I'm joined today by George Goncalves, MUFG's Head of U.S. Macro Strategy. It's Tuesday, June 13th, 2023. Welcome back to the podcast, George.
Hi, John. Thanks for having me.
Yeah, pleasure. Plenty to talk about. As a reminder to our listeners, we are recording this podcast one day before the conclusion of the June FOMC meeting. So, George, here with what I'd argue to be a pretty inline CPI behind us and the Fed directly in front of us, what do you think the Fed actually delivers?
Yeah, so I think this is going to be an interesting meeting for a number of reasons. One, I think like everyone else pretty much now expects the Fed not to hike. This would be the first time since they started hiking rates back last year, which was one of the most aggressive and fastest hiking cycles and took us to levels we haven't seen in well over a decade. That they're going to skip, right? They're gonna not hike. And what really I think we're going to have to discern is distinguishing. This is where the nuance comes in, like distinguishing between, was it a hawkish message that the Fed was trying to convey? Is it really like them trying to use some version of forward guidance, which in the past was very effective? Or, are they really just in this kind of state where they don't know where they are and they want to deliver more of a neutral message and determine a more stronger message at the July meeting where they maybe will hike or not? And what might lie down the road for policy. So I think this is, going to be a meeting all about the nuance, understanding what they're trying to convey. Our base case is that it's going to be at the end of the day tomorrow. Fed meeting conclusion, it'll be conveyed as a hawkish skip, but our probabilities have come down since the CPI report. It was much higher before, and it could be that Powell might get swayed by the doves, which is a growing faction that's starting to really assert themselves on the committee, that perhaps they've done enough and they shouldn't do any more hikes or adjustment to policy. So I'm kind of torn between a hawkish skip, neutral skip, that they are skipping. I don't think they're going to be hiking, so our probability of a hike is zero. They're not going to pull an RBA or a BOC and hike out of nowhere. So this is all about just interpretation and what to expect. Now, there are a few pieces of the puzzle that we have to get through. And there's a timing difference we also have to take into consideration. At 2:00, we will get the official statement, which we think will still have the phrase, the extent to which additional policy firming may be appropriate. That will probably remain in the statement to allow flexibility for a potential hike down the road if they choose to. And this is also a quarterly Fed meeting where they provide us their forecast estimates, the summary of economic projections, the SEP, that will be also released at 2:00, and that will contain their latest thinking on growth, inflation, unemployment. But for us in the rate space, those things will matter as well. But really, the any sort of messaging on the interest rate path that may lie for the rest of the year, as well as 2024, that could be another way to deliver a message that they plan on keeping rates higher for longer, number one, but two, potentially put in another hike, because at this moment, the dots, as they're called, have a median terminal rate for 2023 of 5 1/8, which is where the rate currently sits. So if they really want to get another hike in, they're going to need to raise those dots at least 25 basis points. And so, it's going to come down to that, like the nuance. It's going to come down to, like how are they viewing what's been happening in the banking system since the last meeting. And I think it's going to be a tough message to deliver. Which is why I increased our neutral kind of dovish risks are probably out there. The probabilities of hikes have dropped basically down, but they've been declining ever since a few weeks back when Jefferson, which is a nominee for vice chair, when he mentioned that perhaps a pause or skip is something that should be entertained at this stage, considering all the lags and the hikings, we have to take that into consideration. So I feel like we'll learn a lot, but we're not gonna get actual definitive action. And I think the markets will read through it. I think at the end of the day, the rates markets have done a lot of the heavy lifting, but the risk markets haven't.
Yeah, that's for sure. I think today we almost fully priced out the the small probability of a hike priced in June, but just kind of looking at my screens, I think stocks are up a little, so they don't seem to be moving at all. So interesting. So it sounds like we know what they're going to do, but very hard to say how the market would react. That's going to come down to the nuances. Are they hawkish? Do they give us forward guidance? Do they just not know what to do? So plenty to watch out there for. So I think that kind of leads into the next question. So you sort of outlined the scenarios. So how do markets, react if, in these various scenarios?
Yeah, so like in the hawkish skip, which again still is our base case, but it's a little bit not as strong as before. I think that if Powell channels back his former self from last year's Jackson Hole, where he was much more hawkish, and he looks up and says, financial conditions are easing too much, and that there's still too much liquidity in the system, and that they're looking to reduce it because through the wealth effect, it also impacts inflation. If he mentions things like that around financial conditions have eased, and that that the markets are not taking them seriously, something along those lines. Again, I think it's more the risk market that's susceptible here, and rates would probably sell off too, but not as much. And that's really TBD. It depends on how bad we get a reversal in risk assets. And so I think a hawkish message. The risks lie with the stock market and spreads in high yield, and to a lesser extent IG, but definitely in high yield. It's had one of the biggest tightening moves intra-Fed meeting ever since the start of the cycle. So I think high yield and stocks are definitely at risk here for a hawkish message. On the neutral side, I guess that in the market probably will be relatively range bound. That would probably be true for most markets. But if you look at volatility, especially in equity space, we have VIX already at multi-quarter, if not multi-year lows in the 13 handle. And so I still think that you would see a skew towards risk underperforming like rates at a minimum, but a neutral message. I think it won't be so much what happens on the day of the Fed, but more so in the following few days, which we have a few more events to get through and data into the end of the month. I think it could still end up being the high watermark, is that we saw a big risk rally up until the doorsteps of the Fed meeting, and then markets reassess into the summer that they've taken markets too far. So I think that's for the neutral. On a hawkish side, to really sound hawkish, the Fed would have to change something. They are going to change the dots. I'm not sure if that's enough to actually matter for broader market participants. But if they were to change anything on the balance sheet or the RRP, if they were to try to channel some of this money into helping the TGA with the T-bill issuance that's happening, anything along that lines, I think that would really be the only kind of twist to the story that would result in a more hawkish reaction and bearish market move.
Okay, that's interesting. So to be clear, that's not your base case at all, but that's sort of like a risk scenario
The risk scenario.
Yeah. Okay. All right, got it. Okay, all right. So we got a hawkish skip, neutral, but it sounds like you're kind of a little skeptical of risky assets, sort of regardless. Certainly resonates with me. So as mentioned, we're done with CPI, we'll be through FOMC. Those were clearly the highlights of the week. That being said, there was plenty other events and coming the balance of the week. Why don't you take our listeners through what other data releases and events they should be looking for?
Well, before the Fed, we do have the PPI, and PPI globally for most regions have been coming down. So I think that there's some downside risks there. We're starting to see inflation start to turn the corner even faster. So I think PPI is something to watch before the Fed. But after the Fed, retail sales, I think we have to start pivoting away from just the inflation concerns, but also go back to analyzing where are we really in the growth cycle, and where's the consumer, and can the consumer really turn this around? Can we get a Goldilocks scenario that everybody's yearning for? I'm skeptical of that, and I think that a lot of damage has been done in there, and we haven't felt the full effects of the Fed and other tightenings that's happening all around us, especially with the credit tightening in the banking system and the latest fiscal tightening that's going to happen over the course of the next year or so. So I think looking at retail sales and see the health of the consumer and overall appetite for spending. And then we have these global events with the ECB and BOJ, which they're probably getting closer to being done, at least the ECB in terms of their hiking cycle. So any sort of signals around that, or if they're going to stay the course and remain very vigilant on putting inflation back lower. And that could always move our markets from a correlation risk, and then anything on the BOJ. But I think once we get past this week and we again have all these central banks behind us, then the balance of the month is going to come down to the what happens towards the end of the quarter with month end, quarter end. Those are usually big liquidity periods, or sometimes this liquidity or illiquidity, I should say. And if that were to kind of pick up steam, considering how a lot of assets are priced to perfection, in my view, that you can see a liquidity shortfall impact risk markets. We still have the TGA rebuilding, although it's going a little bit slower than expected. It's still draining liquidity, and it's not really coming from the RRP so far. So, I think there's a lot of unknowns out there for the next 2 or 3 weeks as we get into the start of summer, and I think that we're probably due for at least a pullback in risk markets, and that should favor the bond market.
Okay, yeah, it makes a lot of sense, and given that we've priced out all these all these cuts, through the balance of the year, I think, if I'm not mistaken, we're actually not even pricing any cuts, so if there's a pullback in risk and, treasuries are priced certainly more fairly than they were before, it sounds like, potentially a good opportunity there. So, all right, well, to our listeners, hold on tight, plenty to come over the next, 48 to 72 hours. And for more, don't forget to check out George's June 2023 FOMC Preview and Market Implications FOMC Preview piece. And if you are not receiving George's strategy reports, please do get in contact with him directly. Great stuff as always. Thanks for coming on the podcast, George.
Thanks, John.
And thank you for listening to the MUFG Global Markets Podcast. Rate, review, and subscribe on Apple, Spotify, or wherever you get your podcasts. And reach out to your MUFG sales rep for any further information. Check back soon for more insights from the Global Markets Research Team.